Hi, it's Greg Schnell here, and I'm here with your Daily 5. So I want to talk about a few things going on in the market. One of the big things is about a market, when it makes a top, it's typically a process. What we mean by that is that it doesn't happen kind of on one day like the bottoming process does. So a recent example would be the March 14th low basically went down on a day and then bounced really hard. But when we make the market topping structure, typically we keep trying, rallying and failing and rallying and failing. And it becomes a process to actually try and continually build the top. And what happens on each one of those rallies is we have less and less industry groups participating. So here we sit, and I've got the 100-period moving average, which is the center of the weekly Bollinger Bands, the 20-week moving average. And I've got the 40-week moving average, which is a long-term moving average that we typically see either support the market or in bear markets become resistance. And so just a good rule of thumb is when you're in a bear market, the market will have trouble getting back through the middle of the Bollinger Bands. And when you're in a bull market, it typically rides that 100-period moving average up. So those can just be simple long-term views. So the 100-period moving average here in black is now sloped down. And we can see the 200-day moving average is flat at best. And what we're watching for is, can the market rally through here? And again, each time the market tries to rally, we have less and less participation. But as you go farther down, as the market drops, each rally tends to have bigger bounces. So it makes it more interesting, more like a new bull market is starting, and then it rolls over again. And when it rolls over again, it typically rolls down and makes lower highs. So here you had a rally for a few days and then it rolled down, and a rally for a few days and it rolled down. Now we had a bigger rally and it got back up to the prior highs, but we haven't done anything for 6 days here, and it looks like we're probably going to roll down. So what we want to watch for is, as the market makes that sort of change in philosophy from bull market to bear market, we continue to see weak leadership. And what does that mean? Weak leadership means when growth areas of the market are not leading the market higher, we end up having this problem where the market, as it tries to rally, more or fewer and fewer companies are able to rally within an individual group. So what happens in a bear market is we start to see important indicators start to change. And one of those indicators is the transports. And again, the transports tell us how many goods and services or goods are moving through the market. And so we'll have the industrials who manufacture goods and then the transports who move the goods. We also have materials and energy as good guidelines. But what we typically see is when the transports are rolling down and the industrials are rolling down, it typically tells us there's something wrong with the broader economy. Now, when we had the Fed always buying bonds back and stimulating the market with QE and persistently low interest rates, was it allowed us to invest in tech, and we bought momentum in tech because it had a lot of growth with really very little resistance. The cost of money was very low and it could move up. Well, what happens is, as the cost of money goes up, then the returns required by technology are higher and higher. And we tend to end up looking more at the regular, or call it the old market, where we're actually making goods and moving those goods around as a big part of the broad market. And if that part stalls, that's a good clue for us. Well, what we're seeing here is the transports with that same 100-period and 200-period moving average are stalling. And we briefly got above it, and really it was a one-day move, but we briefly got above it, went sideways, and are now breaking back down again. So we're sitting here where we continually hit resistance from this. What was support over here on the left is now showing up as resistance on the right-hand side. And another group that we like to watch for are the banks. And what we can see here is the banks are very close to breaking down meaningfully, and we can look back and you'll see that October was a low that they're kind of holding so far, and then it was a September low. And if they make meaningful moves below that, I think we're down into a June time period. But here what we see is for the first time is the PPO momentum wave is rolling over below zero. And what that typically helps tell us is that momentum is so weak it can't really recover. And this is where the market could actually move down quite quickly. So we want to make sure that we're prepared for that. Now, again, at any time it could start to move, and I think some people are hoping for a resolution in the war in the Ukraine. That would help us a lot. But the bigger issue we've still got is this rate of inflation is quite big. And so it starts to put pressure, and again, I'm sure we've all heard enough about the yield curve flattening and that kind of thing. But for the banks, they'll end up with having mortgages at 5%, and nobody really wants a mortgage. And it's really because the rate moved up too fast. Not that it moved up, but that it moved up too fast. And so we're sitting here in this period where it's awkward for different industries. And now we can see the banks, where they were typically kind of being supported by these long-term averages, are now struggling to get back above them and are rolling over. So we want to make sure that we're aware of the changes. Now, if we look at what is working, it's utilities that are starting to work. And really, back in December, when the Nasdaq topped in November, all of a sudden the utilities started to break out. And then in January, everything pulled back, and this is pretty important. Everything pulled back. So January to January 24th pulled down, and then we rallied to the first part of the month, and then we pulled down to the February lows, which was the same lows on multiple charts. Then the utilities ran up, and on March the 15th, when everything started to rally, they continued to rally. So this is one example where they actually didn't pull back at all, and people kind of moved into the safety of them. Now, one of the problems I have is when the market moves into utilities, it can be a high-risk part of the market because you're trying to hold something in an uptrend while the overall market is moving down. So you don't know if you're going to have this result or if you're going to have this result here. And my bigger position is to try and just get out of the way. So again, if you looked at the February 24th, the March 14th, and the January 24th lows, you'll see on most of these charts, they're there. So here they are, February 24th, March 14th. In this case, it was a little higher. And here's the transports, March 14th before it took off. Here's the February 24th. So you see it on multiple charts across multiple industry groups. And it's that whole understanding that as the market rolls over, kind of everything feels it, but then they all try to rally together. And it's the size of that rally that we're really trying to find. So what I want to talk about now is the index that we've created at Osprey Strategic is called the Schnell Strength Indexes, and we have 3 of them, but basically they give us a buy signal every couple of months, and in this case, give us a buy signal right around March 14th, 15th, and off we went to the upside, and they got up to the top of their range. And this is particularly helpful, and if they stay up there for a long time, you can see the stock market is in the light colors here in the background. They can help us maintain profits, but what we see is when they roll down quickly, we also want to be aware that the market's getting weaker. And again, back last year in 2021, we had lots of industry groups still with positive momentum. Well, since we've made the market top, we have a lot less. We have less than 50% of the stocks have overall long-term positive momentum. So that's a pretty important thing for us to consider. So as we have these bear market rallies, we need to make sure that we're getting in near the lows and getting out when they're starting to roll over. And that's what this indicator is telling us, that we're kind of peaking out again at the top of these rallies, and we want to make sure that we're protecting our positions if they start to roll away. So with that, if you're looking forward to finding out more about our indicators that help you find timely entries and exits into the market overall, I'm a big believer in protecting capital when the market moves down and trying to join the uptrends when they're in place. That's what we use these strength indexes for. And then we also post some really nice setups every day to help you get on your way with that. So if you're interested, you can head over to ospreystrategic.org, and for only $860, you can try out the service for a year. We also have some shorter time frames there if that interests you at all. But again, the idea is to help you protect capital. And so if you're having trouble here in this bear market environment, you might have you might appreciate the information we try to supply about where the market is in terms of the bounce position and being able to hold through these pullbacks. Now, again, if you're in a big bull market, it makes it easier, but when all of a sudden the market keeps taking away your capital on each one of these runs, it's more difficult. So with that, I'll leave it there. Thanks for taking the time to join me, and good luck. Thank you for watching Your Daily 5.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.